Just us, yeah. That's
Just
good.
us. Hopefully the viewers will be able to stomach it.
Oh, of course
Just
they will.
1 hour.
No, listen, we're gonna have a lot of information that regard with respect to the markets, what's going on.
Yeah.
You know, a lot of changes are happening, so it's
Well,
good
it's
to
a good
review that.
financial catch up because I don't think
Yes.
we haven't done a finance show really
Not
since
in
the
some
beginning
time,
of the
yeah.
new year, and there's
Yeah.
been some changes to 2025. So, it's good to kind of catch up and kind of take a look back, and then while taking a look back, taking a look forward. So
Always. That's the key, right? The key in investing is looking back to see what happened when it happened and see how it may impact the future, right?
Yeah.
And then see if there's something you can do in order to mitigate risk, and that's always the key.
I guess there's a lot of different things we're going to talk about on the show, but I'm kind of surprised. Sometimes people keep using the word uncertainty, and I know you've kind of feel that way sometimes too about the markets, what to look forward with the new administration. But to play devil's advocate, sometimes I kind of sit there and I'm like, there is some level of uncertainty, yes, but in reality, there's also a little more certainty this time than there kind of ever really been in any of our lifetimes, because it's like it's very rare that a president wins an election, then loses, then runs again after that, and then wins, and
right.
So he's back. So you kind of be like, well, I kind of already know how the 4 years go because I had it 4 years ago, and we were talking about when Trump was in the Oval Office. We were kind of like, man, it feels like you just kind of woke up and you blinked at 4 years just passed by. Because usually presidents have successive terms.
Exactly.
And if they don't,
exactly.
they're just gone. But it's just sort of like he was there, then he left, then you have Biden for 4 years, and then now you just blink and just Trump's back. You're like, wait a second, did the other 4 years even happen? It just feels like if you did an Avenger snap, and you woke up 4 years later, you'd be like, wait a second, did he win? No, he lost, but now he's just back again anyway. It's just kind of, it's almost surreal.
And that's a good point, and that's, I always say, people enjoy creating news, right? And so the word uncertainty creates news because now there's both sides of kind of the fence as to no, we know exactly what's going to happen to no, we don't know what's going to happen. And I was thinking about this when I first started my career, right? On Monday morning is when you get all your research papers. So you read because basically over the weekends when people will print stuff, and they literally get it to you by Monday morning. And so there you are, you're reading Monday most of the research that comes out. Today's a different world for two reasons. One is it's continuous, right? Every mutual fund, every ETF, every brokerage company, right? They have some type of analyst, they have some type of economist that is projecting something. They're giving you their thoughts, their opinions, and it is incredible to see the diversity in those opinions. People's like, now the market's had it. No, the market still has some more to go, right? And they give you the rationale. And of course, you also have to step back and say, okay, this is coming from a mutual company that basically their focus is, growth funds, for example. So are they leaning towards, the market's going to do well because they want to sell their growth funds, right? Versus, other companies like, the Fidelities of the world, the Vanguards of the world, where, they got a zillion funds, so they don't have to focus on any particular fund, right? So they can talk about the markets as a whole. But it's just amazing the amount of information that we receive on a daily basis that you have to go through and process, and then take a step back and say, all right, let me think about this on my own, and what do I really think is going to happen? But you made a very good point.
How do you manage all that information? Because, for me, my generation, Yep. Good morning, everyone. Welcome to Today Mañana. I'm Michael. Happy to be joined by Xavier.
Good morning, Michael.
It is a good morning, but it's a little cold. I'm not gonna lie. The other day we were talking about the cold, and I was like, sometimes it's when you get to 32 and 22, it doesn't feel like there's that much difference. It doesn't really bother me. I tell you what, the past couple of days I woke up and it's like, like Jerry said, 8, 9, 10 degrees. And I'm just like, man, I feel cold. Like it's just like a different level of cold. Like you just come outside and you just feel the wave.
Well, you know what it is? It's interesting because, most of the time we're pretty blessed. I mean, you go from your house into your car, from your car into your office, so you're not outdoors much, right? So you go outside, it's like, yeah, it's cold, but big deal, right? Because you're not standing. But like when you guys go for a walk, all of a sudden you're out there 30 minutes. That's when, no matter what you're wearing, gloves, scarf, hat, all of a sudden your fingers get a little numb. Your feet get
but this
numb.
is happening. It's so cool. It feels like it's happening just from the car or the office. It's like you walk and you're like, oh no, I'm already freezing. I gotta get in fast. It's definitely been cold. So definitely today, extra hot. Cafe con leche. You gotta grab. There's no iced coffee today. If you want ice, you just leave it outside for a couple minutes. Boom, right. Bring it back in. You'll have your iced coffee. Let me quickly do the sponsor list because you
Absolutely.
and I, we were literally talking before the.
We were like already.
Yeah, I almost even forgot we hadn't started the show yet. We were just talking. I was like, oh yeah, we started the show. We could have just done it like a radio show. Just have a black screen or just pictures going and you and I talking. But as always, we are happy to be presented by Emergent Financial Services, sponsored by Craddock Series Insurance, Matisse Young Realty, Charlottesville Opera, and of course FABA, the premier Latino networking group here in Charlottesville, Virginia. I know we wanted to cover a lot of financial topics. Particularly, I guess there's we were just talking about the word uncertainty and how that kind of.
And you made a good point. You made a good point, right? So.
I'm not sure if it counts when it's re-recording. So
no.
The point I was making
yeah.
before the show was that people have been
way.
talking about uncertainty. Because you have a new administration, all these other kind of factors that come into play. But I thought it was interesting because in some ways, yes, there is uncertainty because I'm sure there seems to be like a different this Trump administration is kind of working a little differently than the last one, for sure. But there is a little element of certainty in the sense that it's like, well, you kind of already had 4 years of Trump, right? Then you didn't have 4 years of no Trump, and now he's kind of back. Is there any way, like, there's kind of like a basis where it's like, well, the markets kind of did this when he was president, like, there is at least some sort of feeling of exactly how people constantly talk about tariffs. Well, last time Trump came into the office, didn't he put tariffs, or
yes.
did he not? So, I mean, already you kind of like people say, well, we don't know how it's going to affect the market. Well, you kind of do because you already did it, and you already have 4 years of it. So uncertainty kind of, it's like, yes, there always is going to be an element of uncertainty, especially when it comes to the markets, but it's not, I don't feel like people kind of overplaying that word sometimes when it's like, well, at least you kind of have a better sense of how these next 4 years will go or can go versus other administrations that come in and, they're an entirely new president.
Yeah. And I think, I've been around the block enough times and been in this world long enough to have seen quite a few number of changes, dramatic changes, markets that have exploded, markets gone down dramatically. And the important thing is that if you go back in history, yes, every time there's a change of administration, the markets sit back and say, how's that going to impact the markets, right? But that's really, that feeling of what's going to happen is short-lived because then after that, the markets just continue to react to different things, right? Because the most important thing is how the economy is doing, where are interest rates, what's the inflation rate. Obviously, global events are important to the markets. So, and all these are things that really unravel during an administration. They don't just boom show up the first day, right? So even tariffs, right? It's in other words, is the administration going to impose tariffs immediately on everything? Probably not, right? I mean, there's the fear and the risk, but if you talk to the guy that I think he made it clear, the guy that's the treasurer,
Besant or something like that.
I always forget these people's names. They come and go so quickly.
There's so many too.
Yeah,
right?
he basically says that's how you start. You're saying, well, this is what we're going to do. And then you negotiate, right, one by one, because there are products that, you don't want to impose tariffs, and other products that you do. So I think that's the important thing, is that it's just not a blanket tariff, and therefore everything's going to be much more expensive coming from abroad. Therefore, we're going to have inflation, right? That just doesn't necessarily translate to that. Is it possible that, yes, prices are going to go up in certain products? Absolutely. I mean, that can happen, right? Is it possible that eventually those products will be produced here in the States and therefore maybe at lower prices? Yes. So again, these things unravel over time, and the markets react over that. And remember, one thing I always tell people is the market sometimes reacts before it happens.
Yes.
Now, there's an impact to the marketplace, right? There's the news. The market either decides one way or another whether that news is positive or negative. The market reacts and then eventually settles back and say, wait a minute, let me think about this a little more, and then the markets come back to wherever they have to be, right? But so the word uncertainty, you're absolutely right. It's a new administration, but in this case, it's a new administration, but we've seen it before. So it's not completely, like if Trump hadn't been president 4 years before that, you would have sat here and said, oh my Lord, I mean, what is really going to happen? Because this is a complete turnaround to what we've had before. So how is that going to impact the markets? How is that going to impact the economy, et cetera, right? And that's how, that's a focus we have. In other words, how the economy is going to impact by the new administration, right, more than anything else, right? But, and again, and I've always said this, the other thing that's very important to us, and I think it should be important to everybody, is where interest rates are, because interest rates is the value of money, right? In other words, at what price you can borrow is very important. If you have to borrow at 6% versus 4% versus 2%, those are critical components to a business, right? To an entity, to a borrower of, if you're going to purchase a home or trying to start a new business and you have to borrow. This is important, right? Because that is the value of money. So in other words, if your return on investment expectations is 8%, for example, right? And I'm throwing these numbers out, right? And you have to borrow at 6%, that's really tough, right? Because that's going to be a real difficult challenge. If you can borrow 2%, then you have some cushion there, right? So those are things that are extremely important. So interest rates are an important factor to where the economy is going and how that's going to react, right? So I think those are kind of key.
And last month they chose not to lower them, right?
No, they lowered it in December.
Oh, they lowered it in December.
Yes,
okay.
yes. They lowered 25 basis points.
And then before that, they had lowered it 50 basis points?
So they did 25, then 25 before that. The first one was 50, and then 50. 25 and 25. So they've lowered 100 basis points right now.
Okay.
Yeah. So 1% lower. Yeah.
Okay.
Yeah. So in fact, if you look at the 3-month T-bill, which is the one that has the biggest impact when Fed changes rates, right? Because when Federal Reserve changes interest rates, they're short-term rates, they're not long-term rates. So the 3-month Treasury bill is the one that immediately has an impact on that. And if you look at beginning of 2024, I think the 3-month bill was about 5.4%, and right now it's about 4.3, 4.4. So there's that 1% that it's declined, right? Yeah. So that's what they've done.
Yeah, and I know you wanted to talk a little bit about markets, in particular the S&P 500, because you found this stat. Even though I'm going to say it, I want to give you the credit for finding it.
Thank you.
I
read it. I didn't find it either. I read it. I mean,
you read it, but you found it by reading it. So,
true. Okay.
Yeah. I didn't say you came up with this incredible number. It just said you found it.
Yeah.
But the 10 largest stocks in the S&P 500 now make up nearly 40% of the index, up from approximately 30% in December of 2023. So basically in the past year plus, they've gone up 10%. Those
top 10.
Top 10 have gone up.
And that's really, the reason that caught my eye is twofold. One is, you're talking about 10 stocks. The S&P 500 is 500 stocks, right? That's why I call the S&P 500. So 10 out of the 500 stocks compose 40% of that index, meaning their value has grown so much that their market value is 40% of the market value of all the other companies included in that index, right? I went one step further, and I said, I was curious. I said, I wonder what the top 10 is across the market as a whole. The market being like about 3,500 companies, right? It is still 32%. Those 10 stocks are 32% over a 3,500 company. So the reason I think that's important, the reason that is, I think, a challenge for investment managers is that they definitely are in control of the returns of the market. In other words, think about it. If those 10 stocks sneeze, if those 10 stocks go down 10, 15%, the whole market is dropping by a large amount, right? Because they represent such a large portion of the market. So my feeling is the last time we saw this was back, I think it was in the 70s or 60s.
It was right before the little economic dip. That's because I remember you shared a graph of that.
Right.
Xavier had a graph kind of showing the last time there was, such a large percentage of the S&P 500 in a small number of stocks, and basically and that was top 5. So it was a top 5 versus the top 5 today, and it showed how what a large percentage of the index it was, and then you see as time passes by, those top 5 stocks eventually are not the top 5 anymore, which is what you would expect anyway. And I think I remember a few. Exxon was one of them. AT&T was one of them. I can't remember the other 3. I think there's like 3 more. But the whole point is that you sit here and you go, you have these particular companies, and some of these are trading. I think I think they're in front of you also. They're trading at 51 times earnings. I mean, that's just enormous amounts. In other words, you're expecting to have those kind of earnings going forward. And I'm not saying that they can't, and I'm not saying that these particular companies can't have good returns this year or maybe next year. The point is that over time, these companies can no longer grow at the same rate that they've been growing in the past, because otherwise, they're just going to be behemoths, right? I mean, they're just going to be so big that they're going to be incredibly large, right? One company, NVIDIA, for example, right? They produce chips, right? The only thing is that AI, which is artificial intelligence, is such a big part of what we're looking at in today's world that you may sit there and go, they have a head start on everybody else. They have what everybody needs. Therefore, from that perspective, that company may continue to do well, right? And again, I don't know. Right? I'm not saying they will, they won't. It's hard, but it's also gone up so much that you worry at some point, and even a small correction will have a big impact,
Sure.
So, maybe there will be other companies that start develop AI chips. Maybe I don't know how often people need to kind of get new AI chips.
From what we've read, the demand is still much higher than the supply. So there's a backlog, right?
Okay.
Yeah. So and think about it. There's so much. We saw yesterday or the day before where I think between the government and other investors, they're looking to invest, $500 billion, right, into AI for research, for healthcare, for so many things that may be very, very useful, right? The thing that to me also makes, you think about it, say, so these data centers, so these AIs are basically data centers. They require an enormous amount of power, energy, right? Which is rather interesting because if you look at, and I'm kind of going all over the place because I wanted to talk a little bit about diversification, but if you look at just what's happened at the beginning of this year, energy has gone through the roof in the sense of energy stocks, right? And things like consumer staples, things like Costco, Staples, Target, Walmart, they're down this year, right? And so you sit there and you go, so the expectation is that because of the fact that we need so much energy to fuel these things, right? There are areas in the marketplace, and energy is one of them, and that energy can include a lot of things, right? Not just the Exxon and the Conocos of the world, right? It can include other things, obviously companies that produce or generate energy through nuclear, right? And so uranium and nuclear is kind of a large component because it's cheap and it's very reliable. So energy has done very well, and I think part of it is for that reason. Because if you think of energy, it's like oil prices really has skyrocketed recently. So why would those energy companies do well? And it's not those that are necessarily doing well; it's everybody else. Is how do we produce the kind of energy we need in order to have these data centers produce what they need to produce, right? In order for us to have the AI that we want. So, so again, this is, as an investment manager. Right, you sit there and you go, and you've had 2 years, and you mentioned this to me. You've had 2 years, back-to-back years, where if you look at the best performers.
Well, do you actually even have the graph with you? Because
yes.
I think you have it with you. Yeah. So the past 2 years, the best sector of the market's been Russell Growth. I
Russell
believe.
Growth, S&P 500, the MSCI World, and then. Even though it's not exact,
Yes.
and then the European stock market has been in the top 5 really for the last 2 years.
Really, almost the top 6 or 7 are almost
very similar.
exactly the same.
Almost
Except for
exactly the
a
same.
couple of them may have just flipped positions, but
Yes.
literally it's the same exact. And if
Which
I'm
is-
correct, those markets have been up. Some of them, 30 to 40% back-to-back years, or 20% 1 year for it, pretty much.
Yeah, I mean
right?
growth. I mean, let's face it. Russell Growth was up 47%, 42% in 2023. It was up 33% last year.
Yeah.
Those are huge markets. So again, you sit there and you go, and of course, a lot of that in those in the Russell Growth, you have Nvidia, you
yes.
have you have those tech companies. So obviously that's been a large component. So you sit there and you go, it's very rare to see back-to-back years, right? 3 years in a row of such strong performance. Is it impossible? No. Have we seen it before? Yes, right? So it's not impossible, but it gets to the point where it's very difficult to kind of forecast that the market's going to do as well, right? And the S&P, up over 25% 2 years in a row, right? So again, those are very difficult markets. The challenge we have is like, what is generating this growth? And without any doubt, what's generating this growth were a handful of companies.
Yes, that's sometimes the worrying thing that I'm always trying to look at. It's kind of like, okay, yes, the market's been up, but is it just because, again, like Nvidia could have been up, 200, 300% in a single year, or Tesla was up,
right.
100, 150% a year. So it bumps up that number when in reality, if you take out a couple of, like you said, maybe if you take out just 5 out of the 10 largest stocks in the S&P 500, suddenly the market was actually down those 2 years and becomes worrying. Because I think, where is it? Yeah, it's this other stat that you kind of provided here, which might be interesting. It says major U.S. retailers announced more than 7,300 store closures last year, up 57% from 2023. And it says that's the highest annual number of stores closed since 2020, which 2020 was largely due to the pandemic.
Exactly, yeah.
So you're kind of sitting there going, it's like, well, it seems like the markets have been really up, everything's been going great, but underlining data is suggesting that there's a couple issues.
Yeah, and I think we've discussed that before. I mean, so in other words, there has been weakness in the economy, during 2024 that wasn't quite as visible, right? Because when the markets are up, people don't focus on that. But there has been weaknesses in the economy and challenges, and I think the weaknesses are mostly on the smaller companies. Again, financing, very difficult. And, when you have inflation at 9% and the Fed raises rates all the way up to, 6-7%, right? It makes it very difficult for those companies to do well, right? To those companies to borrow and survive, right? So that's going to happen. And I think what you saw in 2023 and you still saw it in some 2024 is basically companies that, because they had to borrow at high rates, they weren't able to make it, right? So you see all these closures. So again, that is, that's a fiber of the economy that is critical, that was really hurting, right? And so I think that's important. So my point is, how do you begin to address these issues, these concerns in a portfolio, so that you can't literally say, I'm nervous, I'm going to go into cash, right? That's the wrong move, because if this is another great year, you're sitting there, you lose another 20%, you'll never make that up, right?
And you don't want to also like you mentioned too, you also don't want to panic and miss out on potential gains. You could be looking saying, oh, look, the stock market's up 2 years in a row. No way it's going to be up 3 years in a row. But that could be folly thinking, because the next thing you know, it ends up being up 20%. And you're like, well, crap, I missed out because, I was like, well, it can't happen 3 times in a row. But it can.
Exactly. Yeah, exactly. So I think I think the key component, probably at this point more than ever, is what we consider diversification, right? I mean, there are times where you may focus, even in a grand scale, you might focus your portfolio, yes, in part S&P, growth stocks, et cetera, but there's a lot of similar securities in both of those indices that you have to be cognizant of the fact that, yeah, the S&P has NVIDIA, so does the Russell 1000 growth. So you are literally investing in NVIDIA in both indices, right? And again, you look through those indices, there's a lot of similarities, right? So you have to be cognizant of that when you invest in people's portfolio. You can't say, yeah, I'm going S&P and growth, good to go, right? No, this is the time you have to step back and say, how do we begin to diversify a little bit of that risk so that we're not so heavily weighted in those companies that did well? And again, you could sit here this year and those companies continue to take off, and your portfolio, instead of being up 25%, you're up 19 or 18%, which is fine. I mean, there's nothing, if you're up 18, 19%, that's a great return anyway, right? But the key thing is that what you don't want is that one time where those stocks or that sector just really comes down hard, and all those gains you had, you just lost them, right? You want to begin to, it's really kind of taking gains out of the table. No, you've got all these gains, you've done very well for 2 years. If you when we look at financial plans, what you're projecting forward is growth between 7 and 8%, right? Because most plans, when you do that, they do very, very well. So if you have that mentality that 7 or 8% over a 30-year period annualizes what you're looking for, and you get back-to-back years where you have in the 20s, you sit back, you say, boy, that 20% is 3 years worth. Right? The other 20% was another 3 years worth, right? So I'm kind of locking in almost 5-6 years of returns that I've had. So instead of losing it, let me pull back. Let me figure out how to diversify that risk, right? That is in those particular companies in such a way that I'm still, invested in the markets, right? But if something really tragic happens, I don't lose so much of it.
Now, when you say pull back, do you mean like selling some of the shares you may have in S&P and Russell Growth just to kind of grab that before it potentially goes down, or?
So, yeah, I mean, absolutely. So you have to think about taking that S&P, taking that growth, and where else can we go? What other, and one of the things, and we do this a lot, one of the things that we've looked at is, you take a look at the S&P 500, basically it's 11 sectors, right? Those 11 sectors, which include technology, for example, consumer staples, communication, finance, industrials, and there's 11 of them. If you look at them historically, and even just month to month to month, and again, I think I mentioned this already. This particular month, since the end of the year to as of yesterday, right? I think consumer staples, which is the Costco's of the world, it's down 1.7%. Energy's up 7%. So look at the diversification between, or the disparity between the best sector and the worst sector. You put them all together and you get the S&P 500. So you can take a step back and say, where is it that I really want to reduce some exposure? So you can take that S&P 500 apart and invest in the different sectors and weight them a little differently, right? So that, again, you're taking that exposure away. And, technology, I think technology is like about 32% of that index. So again, you take that sector and say, I'm going to reduce the exposure there a little bit, and it doesn't be dramatic, but just a little bit, and then put it into other sectors, right, that I think may do well. So again, you're still invested. The weightings in your portfolio are different than the weightings of the S&P 500, and therefore you've really kind of diversified and reduced the risk a little bit.
I see. What you're talking about is more specified type of investing. Is that what you're talking about?
Correct.
Instead of just being in here's an index that tracks S&P 500, here's an index that tracks Russell Growth. If you do that, you think you're maybe diversifying, but in the end, you're basically just keep investing in the same top 10 companies or top 10 stocks that you would otherwise. So, okay, I see what you're getting at.
Yeah.
Okay.
So that's, that's kind of the homework, of what we do because like I said, there are times, I mean, if the market was down 2 years in a row, you can sit there and go, growth stocks, S&P 500, good to go. I'm not worried, right? Boom, go ahead, go all out, right? You can do that.
Yeah.
But now you're sitting there and going, we've had, and think about it, other than 2022, for the last, 4 or 5 years, we've had very strong markets. So you begin to say, how do I begin to kind of, take a little bit off the table, right? And again, not necessarily get out of the stock market, but reduce exposure in some of the sectors that have done so well and put into other sectors that maybe haven't done so well, right? But have good potential, right? And even small cap stocks, they just have been for the last 3, 4, 5 years not done very well, right? Eventually, those stocks are going to return. They're going to do well, right? So there's an area where you say, okay, I'm willing to put a little bit more in that sector of the marketplace with the expectation that somewhere along the line, this sector will definitely flourish, right?
Yeah.
So those, so that's kind of, my thinking. That's. I know when we sit down on Mondays, it's what we've been discussing the most. Is really, and it's hard. It's not. And what we always say. Listen, everybody's portfolio is different. If you're already retired, there's a much more conservative posture there, where income becomes much more important. If you're young, like you are,
what ways would you kind of try to navigate to find income as interest rates kind of go down? What are like the best tools of if someone says I want a lot of income in my portfolio?
Yeah. So I'm glad you said that, because in reality, when you think about it, the fixed income market, right, meaning bonds in particular, have really, they started last year a little high. They came down. Rates came down dramatic. I think that the 10-year got down to about 3.6% in September. It's back up to 4.6%. So now you're looking at 4.6% for a 10-year, right? Pretty close to about 4.5% for a 7-year. The belly of the curve, meaning like 5 to 7 year, is a very interesting sector. At least we think it's a very interesting area of the curve, because it's giving you a nice, healthy yield, right? Without the risk of being in a long bond, that if rates continue to go up a lot, the price of that bond's going to go down, right? So it's really protecting a price a little bit, but giving you very good yield. So looking at where the markets are, we look at 4 kind of sectors beyond treasuries. One is investment grade corporates, high yield, mortgages, and private equity, right? And private credit, right? Investment grade corporates, when you look at it over the last 10 years from a percentile of whether they have a lot of value or not, meaning that their spreads are wider. Spreads meaning, for example, if you buy a 10-year at 4.6%, and you buy a 10-year corporate, investment grade means that they're a high-quality corporate, like a Costco, for example, right? They could be trading at 1% more. So instead of 4.6, you're buying a 5.6, right? If they're trading, instead of 1% more, they're trading on only 50 basis points, 0.5% more, right? You're only getting, from 4.6, now you're getting 5.1, right? So those spreads, what we call spreads, the difference between the corporate yield and the treasury yield, those spreads go up and down, right? Well, right now, they're, from a percentile point of view, they're around like 12, 13 percentile, meaning they're very expensive, right? So corporates in general, investment corporates, are very expensive. High yield has also done very well, right? So high yields is also, from a perspective of expensive, is a little expensive, meaning to take the risk going to investment grade and high yield is also, riskier than it's been in the past. Private credit is attractive, but that requires an enormous amount of research, because private credit is if you think of from risk level, so corporate bonds, investment grade corporate bonds are the least of the risky of the corporate area. High yields a little more risky. Private credit is much more risky, right? So that sector of the market is very risky. Historically, they have the returns almost equal to the stock market. That's how risky they are, but that's how profitable they can be. So that sector is something that is worthwhile looking at, right? Now, mortgages, on the other hand, just government mortgages like Ginnie Mae, Freddie Mac, et cetera, they're on the opposite end. They're on the like 76, 77 percentile of being valued, right? So their yields are much wider than historical. So there's an area of the market where you can pick up some very attractive yields, interest, in a portfolio without the credit, right? Because it doesn't have a credit risk because they're backed by the government, by the U.S. agency governments, right? So again, when you think of it, you can pretty much compose or create a portfolio that's ranging between 5 to 7% income, right, in a very safe, in kind of safe environment for clients. So again, if the goal is to achieve 7 to 8% long term, and if you're retired and you're looking to just get 6 or 7% income wise, it's very achievable right now in the fixed income markets. So the key is how do you lock in those particular rates that are now good, so that even if the rates come down, you've already locked into them, right? So you've got them for, like if you buy a 5-year security, let's say at 6%, you're locked into that 6% for 5 years, right? So even if rates come down, for the next 5 years, you're good to go. At the end of 5 years, yes, you then have to make a decision. What's out there? What's going on, right? And again, one has to be much more active. If rates go up, is there a way to take advantage of that, sell this, buy that a little bit, and therefore lock in higher rates, et cetera, right? And if rates come down, either stay on top of that, ride the wave down. You're going to have some capital. You can have some capital gains if you want in your bond portfolio and try to transition somewhere else. So there's a lot of opportunities even in the bond market to do that. But you're right. I mean, from a conservative point of view, those portfolios that are looking for income, the fixed income markets, are much more attractive than they've been in many, many years, right? So there's tremendous opportunities there where, back 4 or 5 years ago, you were looking at rates at 2%, and you said, I need to buy some stocks for these people that have high dividends because I can't achieve, their 5, 6, 7% goals that they need in order to have that income in their portfolios. We are no longer there. So again, think about how much you've reduced the risk of their portfolio by not having to be in stocks, right, in particular, but being in a fixed income market where their concern is principal, not growth, right? Their concern is I want to keep my principal. I just want that interest and income to come into me on a monthly basis that I can use in retirement. So again, the markets, are, on one side, the fixed income side is very attractive, in my opinion. Doesn't mean rates can't go up. I mean, rates, like I said, the 10-year went from 3.6 to 4.6. Doesn't mean rates can't go up, right? And they might. If tariffs become an inflationary issue, right, the Fed is not going to lower rates anymore. They may think of raising rates. If they do that, right, then obviously interest rates are going to go up. So that's going to impact your fixed income portfolio without any doubt, right? But the way I see it is, even there, I don't think we're going to see right now the inflationary impact that we had, 3 years ago of 9 and 7%. If we have some inflation, it might be 0.5% to 1% higher, right? So the fixed income markets can live with that, and you can survive with that. It's on the equity side where just the component of the indices is what has me concerned. Not so much the economy, not so much what's going on, right? Because again, that's, nobody has a crystal ball that tells them exactly what's going to happen. It's just that you look at, again, you looked at the stock market as a whole, and you sit there and you go, 10 securities represent 32% of the entire U.S. global market. That's a lot. So, at what point do you say, I need to begin to diversify a little bit in order to maybe reduce exposure in those 10 names in such a way that, if things happen, it doesn't impact my portfolio. Okay,
so let's say, for example, I have money in S&P 500, Russell 1000, and I'm sitting there and I'm looking at all these gains. I said, well, I want to diversify more, so I want to take some of those gains and put it elsewhere. When I sell them, do I have to pay capital gains tax on them? Let's say I'm in like a brokerage, not like in a Roth or something. I have to pay, right? And then I have to put it somewhere else. Is there any way I can offset that?
That's a good question. I mean, that's an excellent question because, in retirement accounts, you don't have those issues, right? So it's in retirement accounts, you just trade based on whatever is best out there, what opportunities you see. You're not worried about capital gains. You're not worried about taxes, et cetera. So it's very easy to manage those. On individual accounts with a brokerage account, yes, those are, what the impact on your taxes are going to be is very important. So again, yeah, in that situation, yeah, you need to take a look at, if I'm selling the S&P, but I got a 40% return on what I'm selling, and I'm selling $10,000, then that is going to be obviously taxed at whatever my tax rate is. So if it's 20% and you just sold and you got $10,000 in gain or $5,000 in gains, right? Then basically you're paying 20% of that $5,000 in taxes at the end of the year, right? So is that worth it to you or not? That's a key component. That's something you have to think about. So again, in those portfolios, I mean, we've always been, when you're managing retirement funds, you don't worry about tax consequences. You just find the opportunities, go for them. When you're managing portfolios that are in brokerage accounts where both interest income is taxable, capital gains are taxable, that's where you need to truly kind of diversify the portfolio in a much greater sense. Because if you have a sector, I mean, that would be a perfect example of if you had the 11 sectors of the S&P 500 in that portfolio, right? And where you want to reduce exposure is technology, then you say, okay, I'm going to take some gains in the technology, but I have this sector here that really last year was down.
Yeah, like for example, consumer staples. For example.
Well, yeah, I don't know if consumer staples was down last year, but that's a perfect example if you were doing
chart.
that this year. Yeah. Well, no, yeah, I'm just saying, I just did 1 month, but you're right. And so if you want to do it this year or this month, you say, okay, consumer staples is, energy, technology is up. Well, technology is where I want to reduce. Technology is up. Consumer staples is down. I can sell some consumer staples, sell some technology, make sure that my tax consequence is almost zero, and then diversify into something else, right? So yes, so there's, again, tax loss harvesting in those kind of portfolios is so critical that there are ways that you can do that without, and the important thing here is that you can do that without sacrificing the potential return of that particular sector. In other words, you can sit there and go, wait a minute, so consumer staples is down 1.7%, you're selling where it's down, and what if it's up 3% the following month? Well, there are ways to really reinvest that in such a way that you're still in the marketplace, right? So, that's the kind of homework you have to do, right? To find out, where do I put that, how do I put that, how do I replace those? But then, again, reduce the exposure in the technology in order to do what you want to do. So, those portfolios have to, from day one, when you invest in a brokerage, you have to be thinking that. You can't just, unless you just start, you're young, you just start, it's like, I got $2,000, I'm just buying the S&P 500, fine, right? But over time, you have to start thinking about, I can't let this go so high that then I have such a high, gain that I can't do anything with it, because, if I want to sell the S&P 500, I can no longer do that because it's a large tax consequence. As you kind of fill your portfolio, your individual portfolio, brokerage account, you have to begin to think about that going, and in today's world, so easy because there's, when you trade, there's no commission. It's not something, I'm going to charge me $10 or $5, whatever. It's free, right? So think about, where do I want to be? Can I diversify? Can I buy, $100 of this and $50 of that and, $20 of this? And the answer is most of the time, yes, you can do that, right? So go ahead and do your homework, think about it, put your money in such a way that as the years go on, you can do some tax loss harvesting, right? And so you begin to capture, those tax losses so you can take advantage of when you really need to diversify.
Well, that's good tips, There was also another stat that you had kind of highlighted that I wanted to talk about. It's about the renters. Yeah.
That was interesting.
Yeah, well, it's interesting. It's also a little worrying. I didn't even realize this until you kind of brought it up. So the stat is that renters have less than 3% of the wealth of homeowners. So homeowners have a net worth of close to $400,000, which, naturally would make sense that homeowners would have more net worth than renters, right. But the disparity is alarming. And renters, so it's $400,000 net worth for homeowners. For renters, the median net worth is $10,400. Now granted, again, yes, homeowners have a house, but the median home equity is only $200,000. So you're still even looking at eliminating the median home worth. You still have a discrepancy of $200,000 net worth for homeowners and $10,400 for renters.
Yeah. I mean, obviously, that encompasses a lot, right? So this kind of research, focuses on all renters, right? So there will be, let's be honest, there are renters that kind of live day to day based on their salary. And so no matter what they do, they can't save enough to buy a home, right? So, those are challenges for those people. And that's just if that's the kind of, job and salary you have, it's going to be very difficult for you to achieve buying a home, right? However, I think, part of it is there are also, the challenges that I think renters have, and I'm sure that probably Real Talk talks about this better than I can, is supply and demand. So when the supply of houses is such that the demand is greater, it pushes the prices of houses. So even if you're a renter and you want to buy a house and you've saved some money, but those houses are out of your reach, they continue to be out of your reach no matter what, right? Because let's face it, bank's going to say, how much down payment? And you say, well, if I put this down payment, I'm basically like I have no money left, right? The bank's not going to be happy with that, so getting a loan is going to be very challenging, right? So I think that this statistic highlights the challenges we've had really since about 2006, 2007, where home ownership began to obviously 2008 was the market crash, right, because of that, and the building of homes really declined over time. And it's only been recently that basically people said, I want to own a home. After when COVID hit, everybody said, why am I doing this apartment? Especially think about it, you're living in New York, you got a 30-floor apartment, and you got to take an elevator, and only one person at a time. At 5 o'clock, you're waiting there about 30, 40 minutes to get to your house, right? So you realize this is not what I want anymore, right? These people want now to buy a home. Well, there aren't any available. That's just, the supply is such that it's not quite there. So those are challenges, and those are challenges that unless, building increases dramatically, I don't think it's going to change too much.
But is that not also just a worrying gap, though? I mean, like, really, if you were someone who's been stuck renting now and you're trying to catch up to, financially to where homeowners are, I mean, it just feels like, it almost feels like an insurmountable gap. I mean, it's like, you could come out here, it's like my net worth's $10,000, let's say you've been renting and you're 30 years old. Well, my net worth is $10,000. Someone at 40 years old has got a net worth of $200,000. It's like, how do you get to that point?
How do I get to 210 years?
Yeah.
Again, I think those are challenges. One of the things is you can't group everybody into the same kind of bucket, right? But I think in most cases, workers in today's world probably have opportunities to also save some money in their 401ks. I think that's important. In particular, and we always say that, I know we always tell people, especially young folks, if your company is matching what you put, and whatever that match is, whether 2%, 4%, 6%, make sure you put that amount into the 401k because the rest is free money. I mean, they're putting the same amount of money you are, right? So that is good because even if you rent, at least you know that time of retirement, there will be a true nest egg there that you can use, right? Granted, you don't have a house, you still have to continue to rent, but there's a nest egg, right? The other thing is, and we always talk about this, at the opportunity you have to buy something, whether it be a condo, whether it be a townhouse, whether it be a small house, right? The important thing, like everything else, is getting in the market. In other words, being part of, having already, a foot in the home ownership. And the reason that's important is because, remember, when you buy a home, it is the only time a bank is willing to leverage that purchase. In other words, if you sit here and you say, I've got $10,000, I'd like to invest in the market, but I want to invest $100,000, and you go to a bank and say, can I get a loan for 100 and pay you over time? The answer is no.
Of course.
You can't do that, right? But if there's a $100,000 home out there, the bank will give you that mortgage, right?
Mm-hmm.
So think about it. Your $10,000 was leveraged to 100. If that house, right, grows by 50% in 10 years, the house is now worth $200,000. You only invested 10 in reality, right? You invested 10. Your down payment was only 10,000. So the growth is enormous because it's been leveraged. Your 10 didn't go to 20. Your 100 went to 200, right? So there you are. So that's the one advantage of, like, if you can get into a house, small condo, whatever it may be, you're in it, right? So you're part of it. So as it grows, you are also growing with it, and then there may be opportunities to say, okay, I can now sell this particular condo or townhouse, whatever, and buy a small home or whatever you're looking for. So that's important, right? So you have to think about at what point am I willing to sacrifice and say, yes, I can do this. Does it mean that maybe I have to party less on the weekends? Maybe.
I think, yeah, and I think there's also a bit of a spending issue, I think, with some of the younger generations right now, because we see credit card debt at an all-time high.
Oh, yes.
And some of that is understandable because sometimes, obviously, when you're behind on bills, you end up needing to use your credit card. Other times, I think, with things like Amazon and stuff like that, it's so easy just to kind of go online, purchase, not even think about it, that I think people end up spending more than they really probably should have or needed to. And, you know, obviously, even with inflation, all these expenses start adding up. And I think there's a tool that Alex often mentions with the Roth that, correct me if I'm wrong, but with the Roth, you put money in there. If you actually need the money in a Roth, because if you have pull out money from a Roth early, you have to pay taxes on it, correct? Or
an IRA, you mean, IRA?
No, Roth IRA. If you put money in and you withdraw the money early, you have to pay a penalty, right? Before you No?
No.
Then in the Roth you can, okay, so no, but if you pull out gains from a Roth, not what you put in.
Yeah,
you pull out gains, you have to pay a penalty.
Tax,
yes, you have to pay taxes.
Right.
But if you use it for a home purchase, you don't have to.
That's correct. Yeah.
Okay.
Yeah.
Yes, that's what I was trying to get at.
Yeah. No, absolutely. I mean, that's, you know, those are things we also, I mean, when we have young people come in our office, really the first we talk about is budgeting. You know, let's figure out a budget that makes sense for you, right? And then through that budget, are there ways for you to save? And if there is a way for you to save, you know, the first thing is always a Roth, because that can be your emergency fund, right? In other words, you put money into a Roth, right? It doesn't help you on your immediate taxes, but most of the time that's not necessary when you're young because you're not in a high tax bracket. But you put money into a Roth. The beauty is that Roth grows tax-free. So if you never ever need it, it's going to grow till your retirement, right? However, if you need it, like you said, and let's say over time you put $10,000 in there, the Roth is now worth $15,000. That $10,000 you can pull out for anything you want. You want to buy a car, you want to buy a furniture, whatever it is.
The principal amount you invested, you could always pull out.
Exactly, you pull it out. It's the gains that you can't pull out, unless, as you mentioned, first-time home buyer, and there's other other.
I think health emergencies. I think certain health emergencies will count.
So there, so you can pull out the whole 15. You're going to buy a house. It's like, I'm ready to buy a house. Go ahead, pull that 15 out. No penalty, no taxes, no penalty. Think about it. That money grew tax-free, right? Which means it grows a lot faster if you had it in your brokerage account. It grew tax-free. You pull it out, and you got a down payment. So it's a beautiful way to save some money.
That's right.
Yeah. So there are ways, and listen, this has been good. Again, anytime, I should say, looking at the future is a continuous kind of mantra that we have. I know what's going to happen tomorrow, what is happening today that may impact tomorrow. It's continuous. It's not something just because there's a new administration doesn't mean we're looking at the markets. No, it's just that when there's a new administration, it's how the markets may react to that. And what you want to do is avoid jumping into a fire in the sense that this is going to happen. Let me do this, and then you realize, that was just kind of news. It's really not going to happen. Now you got burned, right? The thing is, step back, think about, and as you meant, at least in this case, it's an administration to a certain respect that was there before, we can go back and say, what happened before? And you realize, well, the markets did very well. So it's not as concerning that you're not as nervous. So the thing is, where are the markets? How are they doing? Are there any areas that are of concern, right? And if there are, how do we mitigate that risk? And that's our that's our philosophy, our investment process on a continuous basis. Is like, if something's done very well, you can't just sit there. And that chart that I love with different colors, it's a perfect example, right? The markets go up and then they come down. The markets go up, and it's rare to have, like we've had the last 2 years, where the top three are exactly the same back-to-back years, right? So the important thing is, if something's done very well, why did it do well? Is it going to continue to do well? Do we think so? Should we take some money out of the table, put it somewhere else? And that's our job. That's what we need to do on a continuous basis. Again, here, when you see numbers as staggering as, the top 10 stocks, it has to open up your eyes and say, do we just ignore it and say, hey, it is what it is? Or do we sit back and say, what can we do in order to continue to invest in those, but maybe, mitigate that risk?
No, I think it was a good show. We needed to talk finance. We hadn't done it yet in 2025, so now we got it off the plate. So, thanks, Pops,
and it's always
sharing
fun.
all your
it's always
knowledge.
Fun. Yeah. No, thank you. No, this is this is what I live for, as you know. I enjoy this.
You don't live for your kids; you live for your finance.
Well, I did that already. Now you guys are old enough. I don't have to live for you now. You're on your own now.
All right, Pops. It was great having you. Thank you.
Thank you.
Being here.
It's been fun.
Thank you, of course, to all the viewers watching. I know, unfortunately, when Xavier and I are on the show, we don't have our computers, we don't have our Facebook, so we can't take all the wonderful viewers watching. But to those who liked and watched the show, thank you so much. We won't be here without you. And of course, always big thank you to our sponsor, our Merger Financial Services, Craddock Serious Insurance, Matissimo Realty, Charlottesville Opera, FABA. Big thank you for Judah behind the camera doing all the fancy work. Yeah, a little less work today.
Yeah, he did. Yeah,
But
so it's half a thank you today. It's not a full thank you. It's a half.
Yeah, half a thank you. Well, 3/4 a thank you, because I'm sure he probably made us look good.
He does that all the time anyway.
Yeah.
I mean, that's his job.
That
Make
is
us look
true.
good. That's his job.
Yeah, but he does a good job with it.
He does.
As best he could. It's tough with us, but he does the best job he could. But of course, a big thank you to I Love CVille. We look forward to seeing everyone next time, but until then, hasta mañana.